Hello, everybody. This is John Blank, Chief Equity Strategist and Economist at Zacks Investment Research. Today, we're going to talk about the ticking time bombs, in the financials sector. So, as always, let's do the disclosure quickly. These are my views and not necessarily the views of Zacks Investment Research, and past performance, which we will discuss today, is no guarantee of future results. Like I said, the title speaks for all of what we're going to do today. Looking for ticking time bombs. Obviously, everybody is concerned about the financial sector being the source of some massive instability and creating a cycle downturn in the economy. So we're going to take a look at that using our system. Part one, a stacked snapshot of the financials groups. I want you to understand Zacks setup. Part two, cash flow, earnings, and net margins. This is an analysis of financials, and what we're interested in here is the trends in the fundamentals. Where are things trending well? Where are they trending poorly? Part three will finish up with a balance sheet ratio analysis of financials. Where should we be worried? Let's get going. Part one, a stacked snapshot of financial groups. Like I said, this is our system, but there's a critical part to it, and I want you to understand this. All right, here it is. For example, we have our system. This is our sector, the finance sector. Within the finance sector is the finance industry, which has these industry groups. Keep this in mind. These are the securities exchanges, not the securities. Those are down investment management brokers. And you've got your commercial, miscellaneous loans, leasing, and mortgage services. So this is basically all of the groups that are financing all kinds of things in loans, leases, and mortgages, commercial finance, and through exchanges. Going up, we're getting into less risky groups, starting with the banks major and the banks regional and foreign are part of that. Then the thrifts and all the regional breakdowns, Midwest, Northeast, Southwest, and West. So these are your core banking groups. This is your central finance industry. And then down here, we've got insurance, which kind of segues out of finance because it is financing things in more of a risk perspective, multi-line brokers, PNC. We've got the investment managers, we've got the investment funds, and then down here, the most risky part of this system, real estate development and the REITs of various types, mortgage REITs, equity REITs, retail, residential, all these different ones. So what you're going to find out here is down here, we've got some issues. Here, mortgage services, we've got some issues. And up here, we do not have issues. I'm going to lay that out for you, but basically keep this stack in mind. It goes from real estate at the bottom, most risky, worrisome, to the top, banks major. And this is effectively what I'm going to find out and show you today. However, we're going to do a lot of relative work. So that's why I took with finance. So we're going to talk about banks major relative to the finance industry a lot of times. This is the thing here. We're looking for outperformances and differences inside this industry. Let's get going. First off, I want to start with forward 12-month revenue metrics. Realize this is an outlook going forward 12 months. So these are people's outlooks on revenue within these groups. So like I told you, we're going to do the regional groups. And you can see out of the COVID shutdown pandemic, pretty much everywhere is doing well. However, they all rolled over back in November. So the revenue forward looks have kind of rolled over. Keep that in mind. Here is the big issue. Mortgage and related services. Obviously, a big spike with early financing and that zero rate environment that Powell caused and then coming back down again. We know what happened here. This is fascinating. That's the commercial lending things. It really took off. Kind of worrisome, actually. And down here, of course, we got all the REITs also doing quite well. And over here, we've got a lot of different things in insurance that I would discount. Real estate operations, I just want to point out this one is declining. This is going to be seen throughout here. We're going to have some worries about real estate operations. That's the COVID pandemic effect because a lot of operating groups are not making money because offices are not filled with people anymore a lot of the times. Here is your first ticking time bomb, real estate operations. Over here, you have the mortgage situation. Those two are part of the story already. All right, as I said, we're going to get into relative performance to finance. So this is all around that one level. here is the one level right now, and you can see basically, for example, banks and thrifts basically perform at in line with finance. Some groups down here do quite well. For example, insurance has been on a run relative to finance for some time now. That is fascinating. I don't understand it, but it's true. And here you've got a declining real estate ratio, but it is well above one. Still at 1.1. Obviously, insurance is 3-1. So these are, if you're looking surprisingly for relative price performance over a long time frame, it has come from the insurance businesses. Not sure what to make of that or even to trust it, but that's what it is. All right, relative ratios, price to book and price to free cash flow. This is your price to free cash flow. This is your price to book. I don't think there's a lot to understand here. My basic instinct is to ignore this chart. It's just too noisy when I see things like this. It just tells me that the data is not as coherent as I would like it. So I'm going to skip this one. All right. So part 2, cash flow, earnings and net margins, and the analysis of the financials. First off, we're going to get into free cash flow per share. It's a nice assist on cyclicality. The basic point here is a higher ratio than one is what's preferred by investors, creditors, and analysts. That means a company can cover its short-term liabilities and still have earnings left over. Companies with high and uptrending operating cash flow are generally considered to be in good health. So here it is, real estate operations. Look how it does. It does fine until basically we enter that vaccination period, and it has declined. This is the worrisome thing. I've already talked about it. We've got a problem already with real estate operations. Net margins, trailing 12-month GAAP earnings. This is also useful. I have highlighted banks foreign. This is the blue line here. You can see that it cycles up through vaccination and comes back down. And this is fairly consistent across all these other groups that it's comparing to inside the United States. So I separated out banks major and banks foreign because here's a nice point where your cyclicality is kind of declining, but it's still strong, basically going back to a trend. Here is the worry again. This is the securities exchanges. Again, this is the bubble. The exchanges, there were a lot of trading activity. Now it's declining. So second thing that's happening is securities exchange volume has dropped off after that pandemic era bubble. I highlighted this. This is concerning. What is not concerning is the banks. Okay, let's keep going. Net cash to operations. This is real estate operations. And again, it's rolling over, and it's very, very unhelpful to see a chart downtrending like this so severely. I just want to point out it is also in this context something that's been happening for years. So we'd have to get into the internals of these businesses to understand this, but this is clearly different. Over here, you can see how the banks perform on net cash per share in the regional context. Again, it's top of the stack, fine, low of the stack, particularly real estate operations. It's very worrisome. Cash flow yield overall. All I want to point out here, overall performance, is we can get into all this, but really all I want to point out is this is the pre-COVID era, this is the post-COVID era. So look at this and look at this. Look at this and look at this. Look at this and look at this. And the basic point is volatility has picked up across the board during the post-COVID era. It's just volatile. People are seeing, obviously, from shutdowns and reentry. It's no surprise given the macro fundamentals were volatile. Cash flow yield was unvolatile. So I just want to point out that volatility is all we're seeing here. Cash flow relative to earnings per share. I'm not sure what to pick up on this. Again, I leave those charts that I don't frankly think are very helpful to the last of each section. This is one of those. Let's get on to part 3. Balance sheet and ratio analysis. This is excellent stuff. Again, we're looking for the time bombs. So let's get going. Return on invested capital is the most helpful cyclical metric. So what is a good return on invested capital? As a rule of thumb, ROIC should be greater than 2% in order to create value. I drew the 2% line in. So here is the 2% line in this chart. Here is the 2% line on that one. There is the 2% line here, and here is the 2% line there. So once again, what we see here is concerning things that are dipping down. And where do I see that? Again, here's real estate operations, not good. Here's the REIT mortgage trust, not good. So basically, again, it's in the real estate businesses. Surprisingly, though, we got real estate development doing well. Why is real estate development doing well and real estate operations not? I think it's because these are positioning in the cyclicality. The opportunities are being found in real estate development because they're repositioning businesses, but real estate operations and mortgages are getting hit. So again, here's a very interesting dynamic. There's not actually worry in real estate development. There is worry in real estate operations and mortgages. So again, at a very high level was not helpful. Now suddenly we found our way to a more helpful understanding. Like I said, return on invested capital is a very helpful metric. Let's keep going. Return on assets. Bullish, again, is the real estate development. I've got that down here. Once again, return on assets is going up for real estate development, mortgage and related services out of the vaccine period collapsing. So bullish real estate development, bearish mortgage services, I pointed that out. So basically here is the longer story about return on assets generally. And when the ratio exceeds 20%, it is considered excellent. When it's considered below 5%, it's worrisome. However, average ratios can vary significantly from one industry to another. This is much lower in financials. Why? Because the assets are what they have in their terms of their loans on their books. So this generally, you should have a different understanding of this. Just basically pointing out the trend is the most important subject here because we're in financials, which has a very different performance with ROA than other industries would. Long-term debt to capital. What is a good long-term debt to capitalization? A good one is anything above 1, which is below 1 are poor. Now, these are percentage terms. You can see all of these are 30 and 40% all across the board. Here is 60%. So in general, all we can find is very little in terms of worry, other than once again, who is levering up? Real estate operations. Real estate operations is getting more long-term debt to capital because capital relative to long-term debt has been falling for some years now. And it's the issue. Like I said, this should not be a surprise to anybody, but we are identifying it. All right, times interest earned. A higher times interest earn ratio is favorable because it means that company presents less of a risk to investors and creditors. So the more cash flow you have above the interest earned, that's better because it has anything better than a 2.5 is considered an acceptable risk. And again, I noted mortgage and related services going all the way down to a 1 from much higher. So this is again now breaking that 2 barrier. And you can just see it plunging, mortgage and related services. Again, that's what we're picking up from the April 21 vaccination down, a big decline. Part of that is, we pulled forward a lot of the mortgages. Part of that is now that we've got the Fed situation. So the combination is really what's disadvantaging that sector here today. Times interest earned 2. Another bubble. This is securities exchange collapse. Again, did fine until people got back to work, and then the exchanges, people just simply started working and not trading, and that took it down. Again, I put this up here again. You're looking for that 2.5 level. So where are we at with the securities? 6. It's not a worry here. So it was a worry for mortgages, whether there's going to be a collapse there. That's back to the housing crisis issue. It's not a worry, actually, from the securities exchanges. This just was an effect of that COVID opening from vaccination and what happened to the loss of volume on the securities businesses. Quick ratios. Generally speaking, a good quick ratio is anything above 1. A higher ratio indicates a company could pay out current liabilities several times over. Again, we're looking for something that's going to be concerning. Here's your 1 level. Generally speaking, I've got stuff in the 0.8s. This is the one, again, I would worry about. That's REIT equity trust. Again, folks, I'm just pointing out what everybody probably already understands. the real estate businesses are where we need to worry about most. Mortgage related services in the real estate operations. And frankly, surprisingly, there's a bull case to be made in real estate development. That's what we learned today. There really are some ticking time bombs, and we really did pick them up today using Zacks Investment Services. And Zacks Professional Services offers this chart system to you and to our, to the YouTube audience that comes on. We thank you for attending. Here is how to get a hold of these charts. 866-794-6065. Email strategycall@zackspro.com. And again, our web address, www.zackspro.com. Also find us on LinkedIn and Twitter. These are our social media ways. I hope you enjoyed today's talk. Fascinating stuff, and I think you probably did learn something about ticking time bombs that is much more granular than you did before. That's the benefit of Zacks Professional Services systems and the work, frankly, of our analysts here, and I appreciate what they did today for you.